morning and welcome to today's Access Breakfast. I'm Joe Pallett. I'm the chair of the Beacon Council this year. It's my honor to be with you here this morning on behalf of myself and the Beacon Council, and I want to begin by thanking the Hotel Sofitel for sponsoring these Access Breakfasts and providing the wonderful breakfast and pastries. I want to thank the Miami Herald business editor, Jane Wooldridge, and Luis Naves, who is the vice chairman of Global Government's Advisors, for being here today and partnering with us on this event. I also want to welcome Doug Hanks, who reports on business for the Miami Herald here in South Florida, and whose report is the centerpiece of what we'll be discussing this morning. For those of you who may not be familiar, the Beacon Council is Miami-Dade County's official economic development organization. Our mission is to grow the job base through marketing Miami-Dade County as an ideal place to grow your business. We have two main goals. One is to bring job-generating investments to Miami-Dade County to help existing companies expand. We work to create opportunities for better paying jobs in our community. Together with Miami-Dade County Mayor and our Board of County Commissioners, the Beacon Council helps businesses meet their location and expansion needs by offering a variety of services to companies interested in Miami-Dade County, and our services are provided at no cost. These access events are one way we provide a forum for conversation of issues that affect our local economy. Today's topic is about how compensation for South Florida CEOs stacks up against the national figures. For those of you who may have had an opportunity to read the report in this morning's paper, you may have found some conclusions that we believe are very supportive of providing additional ammunition to lure companies to our region. Help me welcome today's panelists, beginning with Luis Naves. Luis is, as I mentioned, the Vice Chairman of Global Government's Advisors. In his position as Vice Chairman with the international management consulting firm, Mr. Naves calls on some 20 years of high-level experience in designing and implementing executive compensation programs for a variety of clients worldwide. He holds an MBA from Canada's prestigious Richard Ivey School of Business at the University of Western Ontario. He also attended Harvard Business School's highly selective executive education program. After beginning his career in business and executive management with BMO Nesbitt Burns, one of Canada's oldest and largest financial institutions, Luis served in positions of increasing responsibility in other large international firms such as Mercer Human Resources Consulting Group, Hay Group, and others. His areas of responsibility at Global Governance Advisors encompasses governance issues for corporate boards, human resource matters, and best practices in compensation. Luis is joined today by Miami Herald business editor Jane Wooldridge. Many of us know Jane, but you may not all know that she's an award-winning journalist, entrepreneurial manager, and innovator in multimedia content delivered by both newspapers, magazine, online, and broadcast. She frequently speaks to companies and professional organizations on media trends. In her current position as the Miami Herald's business editor, she's responsible for business editorial products, including Business Monday, Sunday Money, and daily business coverage that appears online, in print, both on page one and through the business section. Through her role, she includes brand management, strategic planning, new product development, trend watching, art direction, interdepartmental facilitation, budget and staff management, new business initiation, multimedia specialization, production management, both in print and online. In her previous role as Miami Herald's travel editor, she wrote, blogged, photographed, and appeared frequently on TV and radio. We welcome both of you, and at this point I'd like to turn the program over to Jane. Thank you.
Good morning. Thanks for being here. Thanks for braving the heat traffic. Go Heat. I'm wearing my white hot jacket. And we're all thrilled to be here. We're really here because at the Miami Herald, I think, I hope all of you know that we take very seriously our mission of providing content that you can't find anywhere else about the South Florida economy, about the South Florida life. And as you heard, and as one of the great blessings of being in this community is life has a lot of different facets to it here in South Florida. One's this morning's parade. A lot of it we try to cover in our business pages. Business Monday, as I'm sure everybody, I hope you're familiar with it, is our premier product. And we're very pleased this morning to be able to be here doing a project that we haven't been able to do for the last few years, and that is to provide a CEO compensation in-depth look at what happens in South Florida at our companies here, our publicly traded companies here, and look at that in the context of what happens nationwide. We will be doing a second look at CEO compensation with our partners, Global Governance Advisors, in the fall, and we'll be looking at Latin America CEOs at that point. But the reason we're able to do this year, there are two reasons. One is Doug Hanks, who does our economy reporting, but the big reason this morning is Global Governance Advisors and our partnership with them. The number crunching on this is substantive. Louis and I have been talking about this for some months, and we would not be able to provide this without their it's not just assistance. They did the number crunching. So we're grateful to you. Thanks very much. And I think, Louis, you're the guy in charge here. So come up and let's chat. Doug is here as a resource for people who have questions about how we did this study, the parts that we brought in, aside from what Louis provided for us in terms of our numbers. So go.
Great, thank you, Jane. So I think we've talked a bit about the Miami Herald and GGA. The only thing I guess I'll add is that GGA is actually one of North America's largest independent boutique executive compensation advisory firms, and we're actually the only locally based firm within Florida. So in terms of we wanted to basically show, what is the value in terms of CEO compensation in South Florida relative to the rest of the U.S. As somebody had posed it to me a while ago, which I found pretty fascinating, and is the fact that somebody asked me, it was actually CEO of a $250 million locally based organization, and the CEO said, "Do you think we have to pay more to get executive talent into South Florida?" And I've been down here now for 2 years from Canada, where the marginal tax rate for executives is 49%. And I said to the CEO, I said, let's see, you have beautiful beaches, you have the ability to go boating, etc., and a pretty attractive tax rate. The answer is no. So in terms of looking into it, we then said, well, let's take a look at the analysis to say, what is CEO compensation in South Florida relative to the rest of the United States? And I think you're going to find the analysis to be fairly interesting. So here's a list of kind of the top 10. We did do the top 25, which is in the Herald today, but looking at the top 25, I guess from our perspective, not surprising, you've got Lennar at the top. And basically, if a board of directors is doing an effective job in evaluating performance and pay, you would have a situation that as there's an upturn in terms of either business or industry-specific business, there'd be an uptick in compensation. And so obviously with the uptick in terms of real estate, Lennar, it makes a lot of sense that you'd see at the top. Just for explanation too, when we say total reported compensation, there really are three major components to CEO compensation across the United States and in South Florida. You've got base salary, usually making up the smallest component, annual bonus, and then long-term incentives. And long-term incentives can be real equity, restricted stock units, deferred stock units, options. So that's all captured in there. And it's the amount provided at a grant value in 2012. We then thought it'd be interesting to kind of put some color to it in terms of what's a CEO worth relative to professional talent or celebrity talent. And the reason I actually think it's interesting is because the world of executive compensation has actually started to take on a bit of that kind of a flavor. In fact, if you actually look back to years ago, before even my profession began in the early 90s and late 80s, it was actually the kind of baseball, professional sports, that really started to look at statistical research in terms of the worth of somebody. And a lot of those same principles are actually today inherent in executive compensation evaluation that boards of directors do, in terms of saying, okay, what truly does the value that individual generate for the shareholders, what does that exercise in terms of the value of the job? So some pretty interesting and obviously staggering numbers. This was actually my favorite. I actually had to triple check that. So I think what this slide actually summarizes kind of one of the key findings from my perspective in terms of the research. So not to be cheeky, but in executive compensation analysis, size matters. So when you're looking at an organization in terms of what a CEO is worth, typically the larger the organization, the more the job pays. Okay, so and I think the behind the scenes on that, the rationale is fairly simple. If you're managing a organization with operating multiple geographies with 100,000 plus employees, you typically would think that job is much more complex and therefore worth more than, say, somebody running an organization that's just within one city and, say, 1,000 employees. So what's interesting, though, about that is when you look at the median total compensation for the top 25 South Florida CEOs relative to across the top 50 in the United States, there's about a 2.5 to 3 time delta in total compensation. But then when you actually look at the relative size, the multiple is actually staggering, and it's nowhere near 3 times the size. And we'll get to that in a second in terms of what that means. What that means is if you try to make it on an apples to apples basis, so what is a CEO, relative CEO paid in terms of the top 50 US based companies versus the top 25 Florida based companies, what you're actually saying is that being a CEO at a South Florida company actually generates you approximately 12 times more in total compensation on a relative size basis than across the United States. That's a pretty telling figure. And when I hear comments about, trying to promote, growth in terms of South Florida and Miami area, this is definitely something to promote. And I'm not sure if anybody in this room is feeling this way, that their compensation is 12 times. So this is actually an analysis that we actually created on a proprietary basis about 8 years ago, and it's actually now used by ISS and Glass Lewis, which are the two most prominent pay advisory groups that advise institutional shareholders on, which we'll talk about in a few minutes, on say on pay. And what we try to do with our clients, and it's a very healthy exercise, and what's now added into the Miami Herald analysis is, too many people focus on what are the absolute numbers in terms of what somebody is earning. And what you really need to do is look at it more closely to say, okay, what are they earning relative to the performance that they're generating? Because as the Herald and Doug quoted in this morning's paper, in Lennar's case, yes, the CEO made $13 million last year, but there was a significant, about $1 billion of net wealth created for the shareholders. There's a good story to tell there. So what you want to be able to look at is what quadrant does the person fall into? You've got performance on the x-axis and you've got compensation on the y-axis. So you don't want to be in a situation where you're actually paying high compensation and low performance, and you don't necessarily want to be in a situation where you're paying high performance or low compensation. And I was asked the question, why not? Why wouldn't you want to underpay a CEO for high performance? Well, they're not stupid. Eventually they'll catch on and leave, and not a very healthy situation for shareholders. So you want to try to be into these two quadrants, which means that the board of directors is doing a pretty effective job in evaluating how much that individual should get paid. And I do want to outline that for most boards, specifically those that are publicly traded, depending on what their governance process is, it's a pretty sophisticated evaluation process. So you're not just looking at 1 year total shareholder return, which is share price performance and dividends paid, but you're also wanting to look at, say, longer term TSR, EPS, cash flow. You know, it varies from industry to industry, but there's a lot of measures that you want to evaluate. But the reason that we picked total shareholder return is it truly is the one measure that at the end of the day, the general public or the shareholder groups really relate to. And typically, I've always told my clients, it really doesn't matter historically how much you pay an individual. If there actually is high TSR alignment, you usually don't get much lashback from shareholder groups. And that's been consistently true time and time again. So here's the top 25 South Florida pay for performance quadrant analysis. And what it basically shows is that there's no consistency in pay for performance alignment in South Florida. So it's all over the map. Certainly you do have some groups that are well aligned in terms of pay for performance, but then you've got other groups that frankly aren't. And what you'll see in a slide to come is, thankfully, it's actually not a South Florida differential. The same thing's happening across the United States. I'm going to actually just kind of talk a bit about FTI Consulting, because what some of you may have heard is, so FTI Consulting, one of South Florida's largest publicly traded companies, actually became the very first Florida publicly traded company to receive a no vote on Say on Pay. And for those of you who maybe don't know what Say on Pay is actually one of the biggest new trends in executive compensation for a publicly traded company in the last, say, 5 years. It was actually born out of the United Kingdom. And what Say on Pay is a vote that goes to the shareholders in which you can actually say, you know, what your views on executive compensation. The key thing right now is that Say on Pay is non-binding. So even though the shareholders vote, a board can say, thank you very much, but we're going to ignore what you're telling us, okay? Now, what has been shown is that regardless of it being non-binding, it's actually quite influential, where if you look at the major pension plans like CalSTRS and others, they basically have taken to the media, actually, in terms of getting traction on Say on Pay. And boards have actually made change based on the negative media attention that they might get over a no Say on Pay vote. But it's a pretty big deal when you get a no vote. What's happening right now in terms of the SEC regulation is they actually are looking with, in cooperation with the United Kingdom and Canadian regulators, of actually making Say on Pay binding. And then you're going to see some really dramatic change in behavior. But in general, this is just giving you some statistics in the last few years on what Say on Pay votes have had. So what you're looking at is actually, in general, a very large percentage of publicly traded companies are actually getting yes votes. And you know, I didn't actually give some examples here, but we're going to talk a bit about the FTI case. But in the ones that have received no votes, and FTI's is actually not that far offside, but in the cases of organizations that actually have gotten no votes, we're talking about $100 million plus payouts. We're talking about a complete, you know, disregard for what, you know, really would be, you know, proper rational thought on behalf of a board of directors. So it's a pretty, you know, pushing the envelope, et cetera. But what is a trend that's happening right now is you're starting to see those shareholders groups actually get even more and more demanding in terms of what used to be thought of something that was a very fair and rational decision on behalf of the board is actually starting to get pushback from the shareholders. So this is definitely something for you to watch. What Jane spoke about in terms of what's going to come out in the Herald in the fall, the Herald will actually have on its website a tool that today is only accessible by subscribers of ISS and Glass Lewis that pay about $50,000 a year for the service, but you'll actually online be able to actually look at and do your own pay for performance analysis for either your own company or companies that you actually have equity in. So it'd be a very valuable tool for the readers. So in terms of FTI Consulting, I won't pick on them too much, but it really is a big deal in terms of being not only the first Florida organization to receive a rejection on Say on Pay, but it actually makes them only about one of 30 companies across the United States in history to receive a no vote. But basically, some of the things that they're actually looking at now that are important in terms of evaluating CEO compensation is the future mix of time-based and performance-based awards. So there was a lot of kind of automatic vesting in their LTI that took place, which was definitely seen as a negative. And then looking in terms of, again, the setting the future targets in terms of relative TSR awards. So in terms of that quadrant analysis, there still are a huge number of organizations across the United States and frankly across the globe that still actually base executive compensation on a discretionary basis. And so, basically what the shareholder groups are saying is, you need to give more thought in terms of paying out millions of dollars, which intuitively makes some sense, yes.
Do you see any difference in the shareholder behavior and attitudes in businesses that are business to business versus business to consumer? Is there a difference?
No, we don't. I think we certainly don't. I think so I'm actually the board advisor at CalSTRS, which is known to be one of the more aggressive shareholder groups. They sued Walmart last year, and they went after Disney for the splitting of the CEO and chairman role. And so it's definitely not industry specific. It's definitely practice specific. Are you following what they deem to be best practice? And I really, again, I don't know what the breakout is in terms of the room, if there's institutional shareholders or retail or what, or board members in the room in that. But the one piece of advice that I will give you is that any board members, executives in the room, is that the ISSs and the Glasgows of the world that kind of create this chaos for companies like FTI, they're not the regulator in that. So, they really have their own agenda, and these are for-profit businesses. ISS is a publicly traded company that makes a lot of money basically coming out with pretty dramatic views on governance issues. So they're not the regulator, so you don't, it's kind of caveat, kind of beware on them, but it's not industry specific. I will say that there's certain industries that are known for paying dramatically more, and those would be financial services and mining and real estate. So again, in terms of the TSR performance, I think, when you're looking at kind of the time frame that, the shareholders were in the FTI case, you can kind of see some of the rationale as to why they felt that there wasn't necessarily justification in terms of the compensation package that was provided. But even more of a reason why you need to look at things more in terms of just a 12-month period. Because if you actually look at the trend line, you'd actually say over time, performance has actually not been too bad. But the way the institutional shareholders are looking at it is on a smooth basis, performance is actually flat. So this is my comment earlier about, the comparing the top 25 South Florida companies to the top U.S. I think boards of South Florida companies don't necessarily have to feel that they aren't doing, that they're doing their job worse than the rest. If you look at across the United States, it's still all over the map. So even across the U.S., you don't have boards of directors with perfect alignment, but the trend is definitely towards better alignment. We did something, sorry.
Well, I was going to say, let's talk for a minute about something that was a conversation this morning, which is that a lot of these companies, and we're looking at our list here, several of these companies actually started as family-held businesses and have become publicly traded, but are still largely family-controlled businesses. How does that affect the way that compensation is allocated?
That's a great question. So some of you, it's a true story. So the reason Microsoft went public was actually because they needed a means for compensating people in a better way, in a more accounting effective way. So they wanted access to options. And I raised Microsoft because there's other examples. So historically, the trend has been that organizations that are kind of family-founded or self-founded, not kind of hired help, et cetera, tend to underpay themselves. So there's a lot of family situations that kind of say, you should make your money off of the dividends and take your $100,000 salary and nothing else. That trend in the last 5 years has really started to go away. And I think this is actually an example in the sense of Carnival and Lennar. You've got second generation or third generation family running the companies, and they basically have said, regardless of the fact that I have almost $7 billion of stock, so somebody might say, my wife would certainly say, who's a teacher, she would say, why does a guy who owns $7 billion worth of stock need more compensation to be aligned with the shareholders? It's a fair point. Well, the trend has really, to Jane's question, been towards saying, well, what's the job's worth? So if Mickey died tomorrow and the job had to be replaced, you'd have to go out and probably pay around $10 million for the job. So that's really what boards have moved towards, is to say, just don't make it about whether it's a family-owned situation or what's the history, just what's the job's worth if we had to go out and replace it tomorrow.
Okay, another question, because I'm essentially a journalist at heart. So, Royal Caribbean recently had a shareholder initiative come up in terms of governance. They, like many companies, have had a CEO, chairman, combined position, still do. And their shareholders made a change in the governance that in the future would make it easier, I believe, to split those roles. We saw that come up with Jamie Dimon. That board did not support that initiative. Where is this going?
Okay, really good question, Jane. So the Jamie Dimon one is probably very well publicized across the United States, frankly across the world. Is something that a lot of people were watching. So the concept of chairman and CEO title is something that, which I think Jane is leading to, has actually been born out of kind of family-founded organizations or self-founded organizations where the founder says, I don't want to just be the CEO and the president, I actually want to control my board. And governance activists are basically saying, well, how can you do that? It's complete conflict of interest, et cetera. And the Jamie Dimon was really interesting because he's a hired gun. He a very different situation. But he basically publicly wrote a letter to all the shareholders saying, if you're going to vote against me to strip me of my chairman CEO title, I'm resigning. And basically the shareholders said, you've done such a great job in terms of being CEO, we'll let you keep the chairman and CEO title. So there's a very dramatic and different situation where somebody who's been a high-performance CEO said, take it or leave it, and the shareholders said, we want you to stay. I'm of the view, and I've worked with a number of hired guns in large publicly traded companies, and then kind of very successful CEOs in family-founded organizations. I'm actually of the view that the chairman and CEO title in a family-founded situation actually works very effectively, because the big difference between a hired gun and somebody that founded the company is to them it's more than just a job. It really is their life. It's family tradition. It's pride. They're in it for years to come, and so they do look at it differently. The one thing that I always recommend in both cases, particularly in a publicly traded company, is having an independent chair, regardless if you have a president CEO that actually holds the chairman title. By having the independent chair, it really does help in terms of adding that third-party independence on that chair. But I think my own view in terms of, to Jane's specific question as to where this is going, I think the Jamie Dimon situation is isolated. I think those situations where there is a hired gun, you're probably going to see more and more of them dropping the chairman title. It's already been happening in the United Kingdom and in Canada. But in those situations where the CEO is a self-made person, I think you're going to continue to see the chairman title being held on and somebody using the independent chair title on the board. Yes, sir.
So a lot of the shareholder activity going on is being pushed by the institutional holders more
Absolutely.
so than what you do.
Absolutely. The institutional shareholders, and more so the ISSs of the world and the Glass Lewis's. And again, if I wasn't clear, what people need to realize is that, so you've got, say, CalSTRS, second largest pension fund in the United States, $185 billion of assets under management. They have their own governance group of 25 individuals, and they basically focus on governance practices at the top 300 publicly traded companies across the United States. And they're very aggressive, to the point, as I mentioned, that they will take litigation against companies over governance issues. Their sole purpose is to increase shareholder returns. Their view is that a better governed organization generates better returns for shareholders in the long term. The ISSs and the Glass Lewis of the world are no different than a DBRS or a rating agency on debt. They're a for-profit, and in ISS's situation, a publicly traded company. They're in it for profit. And so, as I tell most of my clients, you deal with 3 issues, they find 3 more. And obviously, when you're charging $75,000 a year for a subscription to other investor groups, and that if you're coming back and saying, I have no issues being raised, everything's fine, people are going to say, I'm not getting much value. Yes, sir.
Shouldn't your charts at a longer period of time, like your FTI chart? Because the real value of management, if you're a stock investor and you're going to be in for more than just a year or time in the market, then you're looking for long-term performance.
Absolutely.
If you look at your HEICO figures in today's Herald, they're at the low end of the scale, but over time, that management team has produced stellar results. So do you put out studies that go over a longer period of time?
Yeah, absolutely. So we have studies that go back kind of 20 years, and then I think it's actually what Doug tried to look at in terms of the broader picture in terms of today's article. So it's not just time periods, it's actually even other measures. So I'm going to pick on mining. So, there's a good handful of very good mining companies today that on an operational measure perspective have great cash flow, earnings per share, et cetera, but their stock price is 90% down because of gold prices. Some might say, certainly I can tell you that my CEO mining clients are saying, why would you even penalize me on my compensation if I can't control the gold price? Some would say not necessarily an unfair point, but the key thing is that again, we try to, for the readership, keep it as simple as possible in terms of what do they relate to the most. I can tell you that the tool that the Miami Herald is going to be implementing online in the fall will actually have longer time periods and other measures that you can actually play with to see what the performance alignment is. But yeah, absolutely, you want to look at longer than just a 1 year. But if you do a survey of say 1,000 general shareholders, right or wrong, and I would say wrong, most of them are looking at the 1 year period.
Can you do a chart based on net worth increases since CEOs have been known to manipulate their short-term earnings to boost up their bonuses at the end of their comparison?
Yeah, we will be able to actually look at when the so not job specific, but person specific, so that you can actually see when that person took over, look at how much wealth or wealth destruction has occurred over that time frame, which is actually in part. So the Miami Herald, when I was the head of Hay Group, I instituted the Wall Street Journal study, and we never looked at the value of equity, and it's something that the Herald is actually one of the first media outlets to actually look at it. But for that exact point, sir, which is you actually don't want to just look at a 1 year snapshot. Now, this in itself is a bit misleading, because within Mickey's value of equity, there's a lot of kind of founder shares within that. But over the period, you do want to look at how much wealth has that executive kind of generated, and even more importantly, in my view, how much wealth have they actually kept? So, because a lot of this, there's nothing stopping them from selling. So if you're tracking that as a shareholder, insider trading, it's actually a telling tool in terms of, yes, I may have made $12 million a year. How much of that have I actually sold into the market? Because it does send the message that you don't believe in the long-term growth of the stock. So in the case of Mickey, I can tell you he actually has held on, on a lot of the stock. The other thing that is important to look at is the pay mix. So you don't want to be necessarily buying stock or frankly having compensation plan design that is heavily weighted on kind of fixed pay, so the base salary in which you're getting paid just to show up to work every day. So you try to look at companies that actually have a higher degree of at-risk pay in terms of comp design. And frankly, those organizations that have a higher percentage of at-risk pay are usually more well received in terms of shareholder groups. Again, back to the principle that at the end of the day, I'm sure most people today don't really care the fact that the top 3 people that play for the Heat earned $60 million last year on payroll because they won. So, in terms of shareholder groups and investors, they tend to feel the same way. In Lennar's case, you probably don't have a lot of Lennar shareholders complaining about the $13 million that the CEO made last year because their stock went up 100%. It's usually when it happens the reverse that you're going to hear a lot of nasty phone calls and letters. So kind of tying into one of Jane's questions, so this looks at the top 10 value of equity for the CEOs in terms of the top 10 U.S. companies, and we had the slide up earlier in terms of the top 10 South Florida organizations. What you definitely see is back to the kind of the founder situation. The top 10 U.S. companies actually do have a higher weighting towards kind of founder situations, and back to the one lady's question in terms of industry, in terms of wealth, and I guess not surprisingly, there is definitely a higher concentration amongst publicly traded companies of greater wealth created in the technology sector. So I think when you think about it, not surprisingly. We didn't put it up here, but we did do another side analysis to look at, as it relates to executive compensation, where's the highest concentrations of multimillionaires in the United States? Anybody kind of guess what the top kind of 5 would be?
Silicon Valley.
Number 1. I had that wrong. My first one was New York, I thought. But absolutely. California is first. New York is second.
Florida's third because of
You got it.
tax scenario.
You got it. And the 2 that surprised me, 4 is Texas, 5 is New Jersey. So, but the one thing that Jane and I and Doug have talked about, and it's definitely kind of aligns well with kind of the Beacon Council, is one of the things that has never been looked at is the after-tax earnings of individuals. And I think if you actually look at it based on what I just went through, so if you think about it, New Jersey, New York, and California, highest tax burden states in the United States. If you actually look at it on an after-tax basis and couple that with the fact that we're showing that there is a huge premium paid for South Florida CEOs, you actually have an incredible story to take to the market as to why major publicly traded companies should locate in South Florida. So this is back to the kind of earlier slide for South Florida companies, but looking at it from top U.S. companies, not much of a differential, to be honest. So again, final remarks. I think I kind of already stole my thunder there in the last comment, but basically there definitely is a premium being paid to South Florida executives relative to the rest of the U.S. And we don't actually see that necessarily as a negative, because frankly, Wall Street isn't seeing it as a negative. You couple that with other points, such as a much preferred tax rate relative to the rest of the United States for executives. You couple that with incredible weather and the beaches and a great quality of life and a winning NBA team. I'd say you've got some really good reasons in terms of locating in South Florida. In terms on say on pay, it's something that you definitely will see us with the Herald continue to look at in future years. This will definitely be the biggest trend for any publicly traded company to be focused on. And kind of the biggest piece of advice in terms of the last 2 that I can give you as you work through any of your executive compensation issues is be very active on a relationship management perspective with your, say top 5 to 10 shareholder groups. You don't necessarily have to respond to everything that they ask, but always have and enter into that dialogue. In terms of FTI's case, one of the reasons that they got a lot of press, in some case some negative press, is a month before they got the no vote, they actually had released their own article on how you deal with say on pay. So the biggest mistake that I see is people just saying, thank you for the letter, we know what we're doing, and they don't just have a meeting, a sit-down meeting, and they frankly just upset the other party more, and then it leads to kind of the negative vote. But kind of transparent dialogue will really help you.
Louis, one more thing that we don't really focus on in this, we did discuss a bit, is under Dodd-Frank there is I'm not sure if it hasn't been clarified yet, but a rule I think that you're supposed to compare the CEO's or chairman's top executive pay with the pay of an average worker in that industry. Where do we see that going? Do we think that's a fair comparison? Any of us who work in companies sometimes go, ooh, they got another bonus for what? But we're not the people necessarily who are dealing with the executive issues all day long.
So I would say that, is it fair? Probably not fair, but I think it's an interesting comparison in terms of, I think what the regulators in our discussions with them is that they're just trying to allow the average shareholder to understand the dynamics. You know, it's kind of like trying to change, executive pay is like trying to change what a professional athlete makes or what a celebrity makes. At the end of the day, you know, there should be a lot of rationale that goes into it. At times, there isn't. And, you know, I would probably unfortunately say that I don't see the trend going downwards. I think as you project that the stock markets in general for decades to come will actually do well. It's just a matter of how well, but they will go up at least greater than the pace of inflation. Then the fact that executive pay in a large part is linked to equity, you're going to see those packages continue to increase. But again, I think at the end of the day, people do look at to say, well, is it rational? And I think if it's rational, even within, I think what Doug was getting at is even so you can make it rational, but even on the irrational in terms of comparing it to average worker pay, it's irrational. People will still actually go along with it. So I don't see executive compensation decreasing over time, regardless of how much regulation. In fact, regulation, in my view, is what actually increased executive compensation. For many of those that maybe don't know, but in the early 90s, the regulators made it a requirement that public pay of the top 5 executives be publicly disclosed. That was the best thing that could have happened in my industry from a business perspective, and it was the worst thing that could have happened for shareholders, because now you always have situations where Jane or Joe CEO say, I know now how much my competitor earns, I better make more than that person. And it's just a circular exercise. So.
You do similar studies for private companies or boards of directors trying to figure out the executive comp?
Yeah, only for, I find mostly it's organizations that either are larger or organizations that, because of their size, regardless of not being publicly traded, they try to govern themselves like a publicly traded company. In South Florida, not a surprise to many of you, that's a big part of business for any professional service firm, because there actually is a high percentage, more so than other parts of the United States, of very large, well-respected, privately run organizations. But I am finding that more and more so, especially in Latin America, in family-run situations where those organizations saying, well, let's get an advisory board. Let's try to kind of behave more from a governance perspective better. And therefore, yes, that's more that's happening. Yes, sir.
Your study looked at, obviously, the comparison between South Florida and the big major companies in the United States. Was there any consideration, or have you ever looked at, say, South Florida versus other areas of a similar demographic, like Dallas or St. Louis, Chicago, whatever? Because I would think that the companies, the top 25 companies in some place like that are going to be probably more comparable to ones here as opposed to the top 25 here compared to the top 50 in the United States.
Yeah, we certainly have. We've talked about it, and we've even talked about actually maybe looking at broader Florida, so kind of doing a comparison, a regional comparison across Florida. But for this year, we really felt we had almost too much information, but we will be, I think, reviewing that and looking at that in future years to try to keep things fresh.
By the way, what was the geography of South Florida?
It was a good question. Palm Beach, Broward, and Dade counties, there weren't any contenders in Monroe, or they would have been considered. And one of the reasons we went to Palm Beach County, there are a couple of reasons. One is that there are a number of companies in Boca that would affect our scenario, but the other is NextEra, which is the parent of FPL, is located in Palm Beach
each county, and we wanted to make sure that we included them because that's always a topic of great interest here. So we looked at the tri-county area or quad county area, but nobody in Monroe. We have a number of Forbes top wealthiest people in America living in the Keys, but they're not working in the Keys. Living in the Keys.
Other questions?
When your firm turns in and announces a recommendation to the board, when you get pushback, is it typically them saying, why not higher or why not lower?
Most of the pushback, so it depends on which side. So you can have a whole session. Actually, I wouldn't do the session. I always say I'll write a book when I retire. But there are some incredible boardroom stories in terms of the dynamics and the emotional and somewhat unjust issues that sometimes happen in boardrooms around CEO compensation. So I say it depends in the sense that 9 times out of 10 the CEO will always say not enough, and 9 times out of 10 the board will say too much. So I always compare our job, if you're doing it right, to kind of a balancing act in terms of trying to get both sides to kind of agree on something that makes sense and is fair for the shareholder groups. I was telling Doug on Friday, I don't know if some of you know, but one of the things that our industry, our firm has been trying to work on in terms of our industry is there's actually nothing that regulates our industry, okay? Unlike the auditors, the actuary, et cetera. And I would say one of the biggest factors that affects CEO compensation is our industry. Warren Buffett has a saying that there's actually only one profession below executive compensation consultants, and that's prostitution. So, you know, you can do if you have very low ethics, you can do very well financially in our industry. It will only get you so far. But if you know, one of the earlier questions in terms of what can change exec pay is if the regulators would finally regulate our industry, like they did the legal profession years ago and the actuarial profession years ago and the audit profession years ago, you'd see a lot of dramatic positive change. So.
Any other questions we can answer for you?
Where's my picture in the garden?
Jack, you have to put that on somewhere else.
What do you mean?
James, thank you very, very much. We
Thank you
appreciate it.
very much. Thank you.